So if you clicked on this video, you're probably interested or involved in the real estate realm in some way, shape, or form, and eager to reap the rewards of being an investor or a property owner. Whether you have rental property, housing long-term tenants, vacation homes hosting guests every single week, or investment real estate simply being held for the future, knowing your return on investment, or ROI, is extremely important, and you may have an idea of how legit ROI is by the fact that you're watching this video. So in this video, I'm going to break down ROI by explaining what it is and how to calculate it for your own use. So first, let's talk about return on investment and what it is. Now, you may have heard me referring to return on investment as ROI just because it is the acronym and how it's commonly referred to, just so you know. Now, think of ROI as a tool that can help you as a real estate investor concretely predict basically the success of your properties. It can help you see how much money you've made or lost on investment or a project. Now, no one should ever go into anything blindly without knowing what they're going into, so this can be a huge help when deciding to pull the plug or not to pull a plug. Whether you're a fairly new investor or a seasonal one, you can never go wrong with ROI. When it comes to real estate, I highly recommend you use it every single time with your potential investment. Now, ROI is pretty cool because it not only is used for calculating real estate, it can be used for things other than buying property when purchasing other investments like cars to watches to even business ventures to stocks. And to be more specific, Investopedia.com defines return on investment as a measure used to evaluate the efficiency or probability of an investment or compare the efficiency of a number of different investments. So to see how well your investment will perform, you would calculate ROI. The formula for ROI is gain on investment minus cost of investment divided by cost of investment. You'll see what your result will be a percentage or a ratio. And with this formula in mind and staying on track of using it for your real estate, I want you to acknowledge that there are two different ways to calculate ROI. Now, the first way to calculate ROI is for those cash transactions, which will be used if you were to buy a house in full cash. The second way is to calculate ROI for those finance transactions, which would be used if you were considering buying a home with factors such as down payment and mortgages. Now, for obvious reasons, these finance transactions will be more involved compared to cash transactions. Since there are two different ways of calculating ROI based on your transactional situation, I'm going to explain both, but let's start off with ROI for cash transactions. As I mentioned before, calculating ROI on properties where you buy in cash is pretty straightforward compared to finance transactions. To calculate ROI on cash transaction, you ultimately have to know two different things. Number one, your annual return, and two, the amount of total investment you put in. The formula is annual return divided by amount of your total. And to help visualize this, let's say for example, you buy a $500,000 home, but with things like closing costs and renovations, your total investment for the house comes out to be more than $510,000. Now imagine you put the house for rent and you keep collecting rent for about a year. Let's say you earn $36,000 during the rented out year, but then you also have expenses during the time of $7,200. To get your annual return, you subtract your expense, which would be $7,200, from your rental income, which would be $36,000, to give you an annual return of $28,800. With this annual return, you can now calculate your ROI, which would again be your annual return divided by the amount of your total investment, which would be $28,800 divided by $510,000, which should give you 5.6%. So after doing the math, your ROI would be 5.6 on the home. Now let's talk about ROI for finance transaction. Now, in more common situations where you buy a house through financing, the calculation part is pretty similar. For this ROI, you would need to know your annual return and original out-of-pocket expense. The catch for finance transactions, though, is to remember to consider all the pocket expenses, which would be considering like down payment, your closing costs, and your remodeling costs. To help explain this better, let's use the example from before. Let's say you bought the same house, which would be $500,000, but instead of paying cash, you took out a mortgage. This is what most people do, so let's say that your down payment is 20% of the purchasing price of $500,000. The down payment would be $100,000, which is $500,000 purchase price times 20% down payment. You would add up all those expenses like closing costs, which would be $4,000, which is usually higher for finance transaction, and remodeling of $6,000, which would be total out-of-pocket expense to be $110,000, which would be $100,000 plus $4,000 plus $6,000. And at this point, for a cash transaction, you would pretty much be done. But with a mortgage comes ongoing costs. These ongoing costs would be including things like your interest rate, especially with 30-year mortgages, utilities like water, taxes, and insurance, as well as rental income and monthly cash flow that you'll make too. After you consider all of these things and come out to figure out your annual return after a year or so of renting your property, you can then determine ROI by defining your annual return by your original out-of-pocket expense. Now, let's talk about ROI limitations. Now, everything has its pro and con, and since I've already mentioned ROI and why you should use it, I want to talk about why ROI can have its limitation depending on situation. For example, when it comes down to comparing investments, it's likely that the time between your investment purchases are not exactly the same. This time difference can be an important factor to consider when comparing it, as it could end up looking like one property is doing way better than the other, which is actually just simply that the better one has been investment for a lot longer than the new one. This is where it could be crucial for you as an investor to stay mindful and intentional through this calculation process. So after this video, I hope you've gained some insight and new ideas on calculating ROI when it comes to your rental properties. Hopefully this information can help you with more informed and better decisions on your investments, no matter what kind it may be. For those of you who have multiple rental properties, remember to keep factors consistent and constant when calculating ROI to give yourself the most accurate predictions. If you have a property and includes home equity in your valuation, then you should do the same for all your other properties. I hope you guys enjoyed this video. If you did, make sure you guys like and subscribe. And with that being said, I hope to see you guys in the next video.